I think this is an inherent part of the markets, Nikunj, that they do run up ahead. I keep talking about these markets being a lead indicator, right? And the reason that I'm not talking here about long-term economic growth or whatever, I'm just saying is that uh, it's a V-shaped story I've been telling you for quite some time, both on the economy and the markets. Now, the problem is in the V shape is that the fall is very dramatic in a V, and the rise is also equally dramatic. So when you look at it from a perspective of market participants, right? So they are impatient to buy, and the problem is that you can't catch a V, the bottom correctly. In a U, you can say, okay, I got plus minus 10%. I'm okay with buying somewhere in the bottom of the U. But it's going to be a V. You're going to be very quickly seeing a rapid shift in terms of the market, what market is buying. So the participants in the market, right, who tend to second guess each other. That's number one. Number two is that every market participants, bar a few, are all benchmarked to an index. A large cap funds to the Nifty or the Sensex, the small cap funds to the small cap, multi cap to the broader market. So the weightages in those indices, right, means that any fund manager can't afford to bet very deeply against an index heavyweight sector. Let me not get into stocks. So the point I'm trying to stress is that when liquidity comes in, it's going to buy. What's it going to buy? The range of participants. So where is the liquidity coming from? To the best of my knowledge, people who are buying this, right, in the FII and in the DII space are the long-term investors. They're not the short-term, because the short-term, there is a whiplash effect of a further downtrend in the week continuing, and hence they're getting, jacked, as you may use a common lingo there, by it. But a long-term investor, like when you look at it from a drop perspective, let's say there's a 20% drop from now on, just hypothetically. The point is the long-term investor in a 3 to 5 year is saying I have a 300% or a 500% gain. So whether I bought it now, 20% down later, it doesn't matter because my gains are going to be that high. Point number one. Point number two is then what am I buying? I'm going to buy a sector which is going to bounce back, which has got a deep, sharp impact of the virus plus lockdown, but which is going to be a surviving sector, number one. Number two is within sectors, I will look for companies who don't get beaten up so badly, bruised so badly that they go out of business. So as long as they can survive the current downturn, cut costs, tighten their belts, and survive, they are in an ideal position because not everybody is going to survive. So in a rebound, what happens is that these survivors will get a much larger market share. So the rush to buy that which you know is definitely going to survive because that's going to grow with supermarket share in the future. Is then the long-term money says, why do I wait? I've got the money. I want to create long-term wealth, right? And I go and buy now. Let me not worry whether today or tomorrow it's less. So my point here about the liquidity, and if you look at the FII scenario, right? As you know, mutual fund ETF outflows are the ones which have hurt the market in the downturn. But in the bounce back, what's happening? I found out that there's $3.4 trillion of money sitting in money market and cash funds. The first port when all this liquidity was pumped by the US Treasury, the ECB, and everybody, first port of call is safety, which is defined as what? Defined as gold, defined as the US Treasury itself, right? A safety haven. So interest rates started dropping, right? And then safer equity. So that's why the Nasdaq bounced back first because they felt that a tech-based world in this whole lockdown scenario would be a good survival and growth. But emerging markets were the riskiest part. The normal Dow was a riskiest part. So the money which flew out, they said that, look, I don't want to go further put money in gold. I don't want to go further money in fixed income because, rest of the world is already negative. US might go, that's a long shot. But the point is that I'm willing to sit without return on a cash or a money market fund because I want to quickly be able to buy the growth when it becomes visible. So I'm saying if you take the median out of this 3.4 trillion, around $2 trillion of money is waiting on the sidelines. If you just take back to median flows. And mind you, this money is 3x the amount of money that went during the global financial crisis. So you're talking about 3x that kind of a liquidity, all sitting on the sidelines saying, I don't care about my return. I don't want to bet on the interest rates going down and make money off that. I don't want to bet on gold, but I'm waiting